Peter Grandich of petergrandich.com is back. He's been a longtime investor, having worked on Wall Street for many decades before finally working for himself. Now he's returning to the show to talk about his outlook on the economy with some grim warnings for investors up ahead. Peter, you've been the bearer of bad news for a while, but you know what? Turns out you were right, unfortunately, for a lot of investors watching who may not have believed you. Welcome back to the show.
Well, it's always a pleasure to speak with you, David. It really is.
Well, Peter, it's my pleasure as always. Now, Peter, let's talk about your calls that you've made on previous episodes with us. So you've been calling for a correction in the equity markets and a risk, and in the crypto markets. So risk assets, generally speaking, you turned out to be correct. I wonder if it's played out exactly as you had anticipated, though.
Well, it played out in the sense that, as you know, last year, just about this time, I issued a warning saying that starting by our Labor Day in the U.S. and certainly by the end of the year, I didn't want to own any general equities or bonds. And of course, I took even a much harsher stance on cryptocurrencies, calling them the tulip mania of the 21st century, which did open up some interesting responses from people across the world. But I would have been really satisfied if I stopped there, but proving that I put my pant legs one leg on the time, I also got very involved back into the gold and metals market. In fact, this morning before we spoke, I issued a blog post that said I'm now 100% long uranium, copper, gold, and silver stocks. I don't still own any general equities or bonds and still will not go near cryptocurrencies, although I think the inevitable shakeout there that I spoke about is underway, and probably in the next 12 to 24 months, after they go somewhat lower even more, like out of the internet bubble, will come some good companies with blockchain technology for the 21st century, and I would look there, but I still think it's too early to do that as well.
I'm just curious to what kind of responses you've been getting from our previous episodes together. Mind sharing some of the more memorable ones?
Well, I think the best one was, there were some pretty nasty ones. In fact, I got a legitimate death threat, and both by mail and phone, but I'm still here, thank
Guys, stop sending Peter Grandich rude comments and death threats. Come on, let's be civil. But yeah, please continue.
Rude comments are okay. I get them from the wife every day, Dave, so that's all right. But the bottom line is that the best one was after I had called it the tulip mania of the 21st century, some person, and I guess I am not sophisticated with computers as some people are, he was able to send some sort of video that showed a person carrying tulips and getting his head cut off. And he said, "This is going to be you by betting against Bitcoin." Now, I got to say, that was innovative. I didn't exactly like getting my head chopped off. But listen, I think the lesson there, Dave, in all seriousness, is that when things get so extreme like that, and I called it a cult and all, we're now seeing the opposite of that in some markets, particularly the metals and junior resources, where there's just a total despondency and depression. So we've gone 180 in that market. We haven't gone 180 yet in the cryptocurrencies, but I think the worst is over there. I think there has to be more of a shakeout, but there will be survivors. But unfortunately, most of the people that saw 2/3 of the market go to money heaven, they're not going to be able to play again. And that's the sad news in that story.
Well, they'll probably make more money and return to their old habits. The cycle continues down the line, right? This is probably not the end. We're not going to see Bitcoin and crypto stay flat forever, or maybe we will. What do you think?
Well, this is probably going to create the emails again that I didn't want, but I'll answer.
I'm not doing this on purpose, I promise.
The bottom line is that yes, not everything is going to disappear in that. I've always said blockchain technology is legit. What I think it's going to become is, I think people are going to realize that it never will come what they thought it would be from a technology standpoint on how it would interface into monetary and economics. It will be a technology, and like technology stocks, and that's why I think it's begun to trade so in line with technology. When technology eventually rebounds, and certainly after this bear market is over, that's when you'll see those type of things, whichever left, do quite well. I think that's still a ways away, and I think there are some people that have been burned too bad that are just not going to be either financially or psychologically prepared to play that if and when that opportunity comes.
Okay. I want to move on to the crux of what you told me offline, which is that the interest rates that we've been seeing from the Federal Reserve, they will be observed, their impacts will be observed in not just the equity markets that we've seen, but also in the real estate market, and that's going to come up. So I like to preface this by showing the viewers a chart here. This is the new residential construction in thousands of units, so housing starts, released by the Census Bureau. Now, I've noticed that permits and starts have taken a sharp decline over the last month, 2 months or so. Completions have ticked up, so it looks like people are finishing up their construction, but new starts have slowed down. Is this going to signal, or Peter, is this going to lead a decline or slowdown in the price of housing as well, residential housing?
So what's commonly known now as the everything bubble, which we've seen basically burst first in stocks and then bonds and then cryptocurrency. It has one more market where there's been obviously as much of a bubble as anywhere else, and that's in the real estate market, both in Canada and the US. And both in Canada and the US, I believe that bubble is starting to burst. And the difficulty with that is that once it does, and if we're correct that it does, and it joins the other markets at substantially lower levels, the thing that yet has hit the markets in general, and I'm talking general financial markets, is the wealth effect impact of all of this. And so while the recession is likely to come and damper or lessen inflation than where it may be, even though I believe inflation is a lot higher than what the government reports, the negative wealth effect will become the overriding factor and keep markets on the defensive. So yes, I would say to you, we're seeing the end of the big bubble in real estate. I think it's the one that we're going to see the most down over this quarter versus the other markets. And when that happens, I think it's going to be quite difficult for the average investor to feel really good about anything. And I think we'll all see more defensive markets. And that's why, excuse me, Dave, I don't think the stock market has another crash in it, but I think it's going to chop and grind lower into 2023. And that's why I wouldn't yet want to own general equities at this point.
Okay, we're going to come back to stocks. That was a good point. Going back to real estate market now, Peter. So you're anticipating a slowdown, if not a correction, in the real estate market. How severe is this going to be?
Well, I don't follow Canadian markets much, so I can't really answer. But here in the U.S., a lot of the money that has really pushed home prices, and that's what individuals care mostly about. We can talk also about the commercial side of things, but has been from actually investors have been buying up houses, not so much that people just needed another house. And like anything else, when there's more demand, stocks go up. When there was more demand, those homes are going up. But now, if we're correct and there's not going to be that demand, some of these investors are going to start to see some fairly decent losses, and whether or not they'll be able to withstand that will be the question. Now, we also see here in the U.S. money that has gone into real estate investments trusts because people chased dividend yield during the insanity of the Federal Reserve going to zero interest rates. I don't know how badly that's going to be hit. I think more people, as long as the dividends aren't too cut that much, most people will hold them. And that's why I don't think the commercial market will be hit hard as the individual housing market. So I would say that housing is likely to go more down percentage than commercial real estate, because commercial real estate has already kind of been in a little bear market because of the pandemic. And office space and things like that have not recovered and not likely to recover anytime soon.
It's not going to be like an 80% crash in 2008, maybe a 15, 20% correction from here?
You know, it's not how much it goes down. It's the fact that things are just not going to keep going up to what people have been used to. We've been living in a very false premise with substantial returns that just don't make, according to the old economics 101 books and us old relics that still read them, you can't keep having gains substantial as we did and keep on going forever. And the only thing I learned in almost 40 years is we tend, as human beings in everything, go extreme one side or another. So if we reach the peak on one end, we're not going to go back to the middle. We're going to have to swing to the other side. It's like a chart that I sent you about sentiment and so forth and so on.
Right.
We were at euphoria. At best, the market came back to panic. Things like mining shares and junior resources are stuck at despondency and depression, and you have to go through those swings. And of course, when they're at the extremes, it's so difficult to sell when it's euphoria. And when they're at the extremes, when everybody is bearish, it's so hard to buy them. But those are the points normally that have to be reached.
Okay. Well, people have speculated that the real estate market, the residential real estate market, hasn't been worth investing in for quite some time because, especially in larger cities where you have rental control, rents haven't really caught up with price inflation. So if you're an investor in real estate, your rental yield relative to the price at which you pay, where the price at which you're about to pay, if you're a new home buyer, it just isn't worth it compared to other assets like stocks and bonds. Do you agree?
Well, it's a good point that you make, Dave, because the real movement in home prices here hasn't been the individual speculating. It's been investment groups, large institutions and all have been major buyers of homes here in the US. And again, I don't follow the Canadian market, so I can't address that. But like anything else, they're investors that many times can't withstand losses. And that's the other factor. And if we get back to general equities, there's another important fact that hasn't hit there yet that I would address too. So I would just say on your real estate end, that's the first bubble that's just starting to burst now. It was the last one that was needed. And I think then what we'll be talking about, if the good Lord allows me to speak with you again later this fall, winter, or early next year, is now what will be people caught up in the wealth effect, that people have really slowed down because of recession that hit. Everything they owned is down, and it isn't rebounding like it always used to.
What can people do now? It's not that easy to get rid of your home. People still need to find somewhere to live. So you can't just sell your house like it's a stock.
No, and I'm not saying that you have to keep that separate. I never, in the planning that I do, I never try to treat the person's home as their investment. There's a necessity in that.
Right.
What I'm talking about is that people who have played real estate from a pure investment standpoint, that have not only have found their homes, but they have other homes. They've gone into commercial real estate, the REITs that I told you. That market is going to come down like stocks and bonds and cryptocurrency did, in my view. And when you ask about what people should do, there's a great answer that I think people don't focus on, including in the professional community. And that is, and I'm an expert on this, it's not how much you make, it's how much you don't lose, which is going to separate you from being the winners or losers. I think the important thing now to do is not try to make so much money, but not try to lose a lot of money. And that's why I say that if you're still very long in the real estate market, that's a market that can still see 20, 30, 40% loss, and pretty fast, where we've already pretty had that in general stocks, bonds, even in the cryptocurrency market.
All right, so we haven't seen 20, 30, 40% losses in most real estate markets yet, but that could possibly come following exactly that in the equity markets. Okay, Peter, that's a pretty grim forecast. Would you recommend people buy home equity protection or insurance? Basically, it's an index, it's a product you can buy that rewards you or gives you a payoff if the underlying home, the underlying asset, your home goes down in value?
I don't believe we have to be hedged in everything.
Okay.
I do believe if normally one should be in a home for a long outlook. It shouldn't be something that we're moving to. I will tell you a big change here in the US, and I don't know how it affects people in Canada. But one of the things that's clear and evident from all the studies and people that are watching real estate closely is millennials or younger folks are not buying the big homes that once my generation 20 years ago couldn't wait to own, the 6, 7, 8,000 square foot homes, things of that nature and all. And the other thing that's happening, because we have an aging generation, 55 and over, and community homes that also help lead to nursing care and things of that nature, is more likely to be on the growth end than people that were building like I said, the big, huge luxury homes. Luxury home sales are probably the ones that are going to be hit the most, including super luxury, than say, 55 and over
Really?
communities. Yeah,
I
only because of demographics
ah.
and where people stand and so forth and so on.
See, I would have thought this is my theory, and please correct me if you don't agree, but I would have thought that the super luxury homes that you're talking about, the ultra high-end condos and the large houses and mansions, there's a market for that because the wealthier people, they're not affected by recessions as much, and so that market is still going to get bid up if there's still demand, as long as supply isn't drastically increased for that market. It's the middle class homes that are going to suffer the most because regular folks are going to get hit by a slowdown more severely than the wealthier folks. What do you think?
If you have a $40 million condo, which is not unheard of in New
Okay.
York and Miami and places like that nature, and you can afford to be in it, you're right. If it goes from 40 to 20, yeah, you still got 20 million supposedly if you paid cash for it and all. But I can tell you this now, I worked with some of the more wealthier athletes
Mm-hmm.
until a year ago when I left the sports because of things that the sports world has come to. And I can tell you, wealthy people, at least from the athletes I dealt with, are more leveraged now than probably at any other time when people were wealthy. And so a lot of wealth that supposedly is out there is built on a lot of leverage that didn't exist years ago. So I can tell you that I will not be surprised that if and when things get even more severe, you are going to hear stories of real wealth people losing a lot because they have, I used to tell the players, just a side Dave here, that the NFL stands for not for long. So I'd always try to tell them that
Uh,
even though they're in the half of 1% of all the wealthiest people in the world, even the third string guy was that compared to the rest of the people in the world. I used to say to them, listen, you have to understand that you don't need that much more, but there's this more money equals more happiness society that is prevalent thanks to Wall Street and Madison Avenue and all the other people, and they get caught up in it. Now, is it easy if you go from 100 million to 5 million? Yeah, for the person that has no money, they would love to be. But those people, when they have those issues and lose like that, other things impact them in their lives too, family, personal health, the way they look at life. So I understand what you're saying, but I see this is going to be damage across the board. It's not going to be limited to just the little guy this time around.
You know what? Let's talk about personal finance because that is something, an area in which you are an expert. So you've consulted a lot of wealthy individuals, NFL athletes, like you mentioned. We hear stories of NFL athletes or NBA athletes, professional athletes making a lot of money and then losing that money very quickly. Doesn't happen to everybody, of course. We've got several examples of notable athletes that have gone on to become billionaires because of wise business decisions that they've made. But the point is, people have squandered a lot of money. It doesn't matter what field you're in. If you become wealthy, if you don't know what to do with that wealth, if you don't manage your money properly, you can lose it all very quickly. This is a very timely discussion because a lot of people are concerned about what to do to preserve their wealth. So if you have a sum of money right now, and let's say I don't know what to do with my money, Peter. I'm afraid that I'm going to lose my money to inflation. I'm afraid I'm going to lose my money to this recession that's possibly coming up. We'll talk about that later. I want to know what I can do to preserve my wealth. What tips do you have for me to either invest or to not squander my money?
So the philosophy that I have, since you asked, I will tell you, first is built on what I call my Catholic Christian foundation. And because of that, I depend on a book. Now, some people can look at it just as another book. It just lasted for a couple thousand years. I view it as a manual to life. And the author or authors, whether they were godly or just a bunch of good people that wrote a bunch of good stuff that a lot of people wanted to read for a couple of thousand years, irregardless, one of the topics that is constant in that book, and there's not a positive verse in it, and that is about debt. I think debt and the way at least Americans approach it, has caused a lot of the issues. So one of the things I always talk to, whether it was one of the top-notch professional athletes or one of the just general working people that came through our doors, is less is more. And it was hard for me to take that. Dave, there was a time, I know you can't believe it or not, but I was a young guy like you. And not only was I a legend in my own mind back then, but I was turning the 10 commandments into the 10 suggestions. And one of the reasons I always like to bring that up is we get caught up in worldly stuff. And so one of the things that has to shake out here, and what you're going to see, is there have been a lot of people at all levels living beyond their means. Dave, I would say 7 out of 8 people that we meet in our planning group, whether they're working or the athletes we used to deal with, are living at least one lifestyle above their finances, not one below that. And if you look back to our parents or grandparents, it really doesn't matter what ethnicity you are or what country you're from. Our parents and grandparents lived with less. You know how I know that? Because they didn't have public storage back then. But you don't have to drive anywhere on a major road in Canada and the US without running into a public storage facility. Why? Because we have too much stuff. In fact, George Carlin used to do a great skit about that. But what I would just start with people, irregardless, is less is more. Debt isn't the answer. If you can't afford to buy it, maybe you should think twice. And if you ask me the change in 2 generations, our parents and grandparents used to ask, can we afford it? Now young folks ask, can we make the first payment? And I think we got to look out past the next couple of months and all. And like I said, I think we need to take a step back. And I think we're going to have to, because we can't keep going the way we've been going as a country here in the US, living off, I'm not the only one that called this, but monetary heroin. And we created this illusion of wealth. And the reality is more people falling back, Dave. There are more people on food back lines, more people seeking real assistance just to get by each day. And I think, unfortunately, that's going to get worse before it can get better. So long answer, first start with an idea that less is more. I think any financial plan should be that way. A lot of people don't like to hear it, and that's why it's not said by a lot of financial planners, but it's certainly something that we do.
Is there like a rule or guideline you follow or advise people to follow before they buy something? For example, I've read in some forums, before you buy something, think about it. Ask yourself, can I buy this thing twice right now? If the answer is no, I probably shouldn't buy it.
That's a very good formula. I'll tell you another thing, Dave, since we went down this road and I feel we've been led to talk about it. This is real important.
Yeah.
Having lost millions, not once, but twice in my career, I know that's hard for people to believe that somebody in the financial world actually loses money, but you're looking at one that has. One of the things I learned in that is mental anguish. I got over the financial losses far faster than the mental anguish of losing. And one of the things I don't think people plan when they sit down for planning, either the planner or the planee, is what happens, like you said. Let's say if this goes wrong. Let's say if something blows up. Can I not only afford the financial, but how am I going to handle this mentally? I see mental anguish ruin more people than any financial loss. So I think it's very, very important that we can understand the psyche of what may occur if our judgment is wrong.
Okay. Well, wise tips to follow, and we'll certainly take your advice and wisdom to heart, hopefully. And please, guys, stop sending Peter Grandich hate mail and death threats.
It's all right.
Stop it. I want to finish on the recession and investment implications. So fears of a recession are rising. If you actually just go on Google Trends and look up the word recession, the search volume has been rising. The yield curve just recently inverted. That's no good. Usually an inversion of the yield curve leads coming economic slowdown, if not an outright recession. So what do you think? Is it, are fears of a recession overblown, or do you agree with people who think that a recession is coming?
Oh, I think it's here already, Dave, but I think the important thing to accept in this, and I think you're going to have to, whether you like it or not, is 2 things are certain to happen over several months going forward. Profit margins are going to shrink. We have not seen analysts start to take down their predictions of earnings, 3rd, 4th quarter into next year yet. There's clearly going to be, that's going to change because profit margins are going to shrink in this. And the other thing is liquidity. There's not going to be the liquidity that existed 12 or 24 months ago. So I think with both those things happening, the likelihood is that things have to get weaker and lower than go higher and stronger. So I think that's the bet and the likelihood. What's real interesting, and this is a real important 2 things, Dave. One, regarding the markets, we have not yet seen over half the money that's in the US market now is in passive funds, which means they're not actively managed. And when the market was going up, that was easy. The manager didn't have to worry. He got new money. He just bought the stuff that made up the index and went forward. But now if the general public starts to want to move out of the market aggressively, there's not going to be a manager to sit there and go, oh, wait a second, I don't think you should, or maybe you want to hold these stocks and all. They just have to sell. And that we haven't seen yet. So that's an important thing in the market. But I also want to get across to you, perhaps the news story you will be talking about in the next 12 months. This recent meeting of the BRIC nations, we had both Putin and Chinese officials publicly state that it's their intention to introduce a new currency and that they've already begun trading away from the dollar. I believe that is a news story that if you're not paying attention to and understand the ramifications from it, you better. And part of that is because we're going to see a peak in the US dollar. It's likely to happen with the euro breaking parity and everybody reporting that and all. And at that point in time, if I was long US dollars, I would look to get out of it. And that's been one of the things that's helped suppress gold from getting up the higher. And I think that's going to be the key to ignite gold. But I see that happening now fairly soon because they're openly speaking about it. And we're seeing other countries, including the Saudis, talking about joining the BRICS. So this is a new story that's not getting a lot of coverage and may still not for several months, Dave. But I think it's something people should start to at least focus on and learn more about.
Let's follow up on that next time. Okay, finally, you've allocated, I think, all your money into metals now. This is a recent development. Tell us about that.
Well, it's not something I don't think 2 or 3 people in all North America would say that they're in right now. But for myself, I'm a riverboat gambler. I've always said Wall Street created the word speculating, so it doesn't have to say gambling, but it's gambling. And this time different than 2018 when I came back to metals after a 5 years absence. I've not only done it for gold, but uranium is my absolute favorite commodity. But through uranium, gold, silver, and copper, that's my entire portfolio now, and it's 100% invested. I would barely have enough cash to buy you and me lunch. So I'm fully in, and I believe, I don't know if I'm at the exact bottom, but I think we're seeing all the things that one would want to see in those markets. And the junior resource market has been annihilated. I think we're going to go through an L-shaped recovery, which means, Dave, as excited as I am to be long this, I don't think it's going to happen in the next few months. This is an investment for 20 and 23 and beyond. But I do think they're at a point now, for me at least, as a gambler, that they're a very, very good gamble at this point in time.
Well, listen, I hope it works out. And yeah, you and I will definitely go to lunch.
As I said in my blog post this morning, if it doesn't work out, it's goodbye for Peter. So,
well, Peter, you've been right several times before, including your call back in 2018 when you moved everything into gold, and look what happened to gold. So maybe you are a leading indicator for what's to come, the bull run in the precious metals market. So let's definitely follow up on that. And either way, win or lose, we'll have lunch one of these days when I see you next. Thank you, Peter, for coming on.
That would be my pleasure, Dave. God bless you. Take care.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.